Okay, let's just dive right in. It's that time of year, and the one question we hear constantly is, where's the money going to be made in 2026?
Exactly. People want to know what to buy now. Equity, gold, silver, crypto, real estate, you name it.
But that question, it almost misses the most important part.
It does, because there's this sort of golden rule that changes the entire perspective. When you look at the historical data we've pulled, the fascinating thing is that all of these asset classes, literally every single one, has made people money.
If they stuck with it long enough.
That's the key. If they maintained a long-term view and just, well, endured the ride.
It's like building a tower, isn't it? If you have that solid base, knowing that everything works over time, you're strong. But if you're just chasing the next hot thing for 2026...
Your foundation is sand, and it's just a matter of time before it collapses.
Right. So let's start with equity. We use the Nifty 50 as a benchmark here.
And the long-term average is great. A compound annual growth rate of around 14%. Solid.
But that average number hides so much pain. I mean, what about the 2008 crash? When the market drops 50–60%, that 14% average feels pretty abstract.
It does. And volatility isn't just about crashes either. I mean, look at 2025 in our data. It was what you'd call a muted market, right? Only about 10% returns.
Yeah, totally boring by some standards. But that stagnation is part of the cycle. It's a feature, not a bug.
And that's even more true for something like gold, which people think of as stable.
Oh, excellent.
Gold gave investors these crazy 70–80% returns in 2025. But if you look back, there was a period from 1951 to 1964, 13 years.
13 years.
Where it did virtually nothing, just hovered. So over a decade of dormancy, yet the long-term average is still decent, around 9 or 10%.
It just requires so much patience. And if gold can sleep for that long,
yeah,
anything can. Then you have silver, which is, well, it's on another level.
It is. The swings are just extreme.
You had that brutal drop in 2013, something like 35 or 36%. And then, boom, this recent madness with a 160% surge in 2025.
And that's the kind of thing that triggers massive FOMO, the fear of missing out.
Yeah, everyone piles in right at the top.
Exactly. Okay, so what about the digital side? Bitcoin.
Right. Huge crashes there, too. 70% in 2018, another 60% in 2022. It's volatility baked right in.
It is, but it's a different kind of long-term hold, I think. You're not just betting on the price. You're sort of betting on the survival and expansion of the technology itself.
That makes sense. And finally, real estate. It makes money, of course, but it's so dependent on location.
Heavily. The data suggests Tier 1 cities are getting saturated. You might need to wait 15 years for good returns.
Whereas Tier 2 and Tier 3 cities could offer better yields in, say, a 7 to 10-year window. So long-term itself changes.
Right. So if we connect all these dots, what do we see? Every single asset class has had these wild peaks, like silver's 160% gain and these deep, painful crashes.
And the short-term view makes you chase the engine when it's already red hot.
Yes, and it leaves 99% of people to completely ignore the sectors or stocks that are currently muted or, on sale.
So the bottom line, for you listening, is that the players who just stay in the game, who endure the drawdowns, they actually get a great average return. Nifty around 12.5%, gold at 12%, silver around 11%.
They're building that steady tower with materials they bought at a discount.
So here's the final thought I'll leave you with. If history shows that all of these assets give you a decent average return over time, what risk are you really taking by focusing on the short term? By chasing what's hot for 2026 instead of patiently studying what's currently unpopular, what's discounted, and building from there.